Welcome back to the channel. Today we're going to share about one metric that we use to quickly tell if a company has stronger products and services moats compared to another, right? So before we begin, we'll let you know that this is actually not a definite approach, but it could quickly help you to differentiate between stronger and weaker companies for you to deep dive and do further research into, right? So to tell if a company has potentially stronger products, services moat, and thus equating to stronger pricing power, right? We have to look at the metric called gross margins. So what is gross margin? So gross margin basically is your revenue minus cost of goods sold divided by revenue, right? So before we explain further, I think there's this one quote that I'd like to share with you, made popular by operators and business owners around the world, right? Which is revenue is vanity, while profitability is sanity. So it doesn't matter how fast you grow a revenue or how big it becomes, right? It doesn't matter if it's not sustainable, right? Eventually, at the end of the day, everything still boils down to net profits and your cash flows, right? So the goal of businesses is to generate cash flow, right? So even if you achieve very high revenue, but it doesn't bring in any money, it's still loss incurring. It doesn't matter at the end of the day, the business will eventually go bankrupt, right? So gross margins, in a sense, will let you know if a business you're building is scalable or not, right? So one very prominent example and recent example is back in 2020 to 2021. There was a huge boom in lots of stock prices of growth companies, right? They were mostly brought public by either SPACs or IPOs then. So a lot of these companies also came back crashing down because a lot of their revenue growth that's has a boost from COVID-related work from home, etc. Narrative, right? They didn't really sustain their revenues and thus profits after that, and then a lot of these businesses eventually the stock prices never recovered after they come crashing down back in 2022 and 2023, where the Fed raised interest rates to fight inflation, right? So just to provide you some context, that gross margins and eventually profitability is very important if you are a long-term investor. So what is gross margins, right? So more specifically, gross margin is the percentage of revenue remaining after deducting the direct cost to deliver a company's product. So for example, if you are in the plastic bag business, right, it is a raw material needed to produce the plastic bag that you sell to consumers or businesses, correct? So it accounts for the expenses a company incurs to produce and sell an additional unit of the offering. So basically, it's a true cost to produce each item of its output, right? So let's take an example. Take a look at example, Palantir, right, versus Stitch Fix, right? So both of them were quite popular back in 2020 to 2022. Both of them are growth companies then. Their stock prices jumped up heavily, and then after the COVID, interest rates were hiked by the Fed to fight inflation, both of their stock prices came crashing down. But there's one clear winner among both of them, right? So Palantir and Stitch Fix. If you tell the share price from today, Palantir has recovered and made like tremendous amount of the returns for investors, while Stitch Fix never really recovered, right? So what's one way they could tell that? Well, there are a lot of other factors to account for, but what's one quick way to tell which of them would be more sustainable as an investment in the long term, right? So now, gross margins, if you could tell, right? Palantir has very strong gross margins, right? Consistently above 80%. While if you look at Stitch Fix, its gross margins for a tech company is very, very weak at around 43.61%, right? So weak gross margins, strong gross margins, and look at their share price recovery, right? Palantir recovered very nicely, while Stitch Fix has declined and never really recovered then, right? And you could tell also Palantir's revenue has been skyrocketing, while Stitch Fix, after the COVID boom, started declining and never really take off again. So gross margin is a quick way to tell whether either of these companies has a stronger product moat and services, right? That could help it dominate this industry. But that said, there are many other different factors to account for, like the type of nature the company operates in, the product and services, and many other factors such as narratives that would industry tailwinds, things like that will help the share price. So Palantir has obviously benefited a lot more from the whole AI boom, while Stitch Fix didn't really, right? But just to provide an extreme example in case where gross margins could be telling for growth companies, which of them have the stronger long-term runway, right? So that said, right, what is a good gross margin benchmark? So the answer is it really depends on the industry, right? So software companies would have higher gross margins, right? So it's easier to produce an additional unit compared to, say, your oil and gas companies, which has high capex, right? All your equipment and machinery needed to drill oil. So, but we're gonna talk about the example for growth companies, right? So, for growth companies, it's anything above 75% usually good, but most of the time their gross margin range will be around 70 to 85, right? Red flags will be anything below 70%, right? Especially for SaaS companies, the tech space, right? So what could lead to the low gross margins? So number one, high delivery costs, right? So it actually lets you know that the company actually rely heavily on the implementation team, customer support, or they have just very high infrastructure costs to scale their products and services, right? Which is usually not a good thing, right? You want your delivery costs below, like what Microsoft done in the past, right? With the whole Microsoft Office suite, right? Their cost of selling an additional software product to their customer is very, very low, right? We want that kind of scenario to happen in the tech companies that you invested in, right? Number two, inefficient pricing or packaging. So this could mean that either they're pricing too aggressive in terms of their discounts or underpricing tiers, right? Or it could also mean that the company is struggling to capture the value of the product, right? So this also signifies heavy competition in the market. So if you are like a true monopoly, a true powerhouse in the industry, you have a lot of pricing power, right? Because none other competitors could price their products similar to yours because of the value that they provide may not match up to the company that invested in their products, the value that they bring, right? So if a company is having issues pricing strongly, right, it could signify that either their products and services are on the decline or they're just not matching up, which is not something that you want to invest in, right? Invest into. Number three, there could be a business model mismatch. So maybe they're too service heavy, or the business model is more like a service company than a software company. So this business model mismatch will always depend on industry, right? So you have to take that into context, correct? And weaker gross margins could ultimately impact your valuation, right? So for example, of SaaS companies, right? The valuation of companies with high gross margins are above the industry average valuation multiples historically. You could take a look at your reports online. This is usually the case, right? Even if you compare the companies that that's very popular nowadays, like your Stitch Fix, and then you compare it to another SaaS company like don't really have one on the top of my mind, but if you compare it to another winner in the industry, you could tell that their gross margins is likely to have a difference, right? So why is that so? So higher gross margins means there's a greater chance towards the path of profitability or higher profitability already, right? And this could also mean potential stronger moats, which is why they can charge higher and there's less competition around, etc., right? Because of the value they bring, they can charge at that high. And also, high gross margins means that if there's a new competitor coming in the industry, they could potentially give them leg room to, compete in terms of price discounts. But you don't really want to see this happening as well. Yep. And it could also mean that they have the ability to increase pricing down the line without increasing churn or impacting retention, which is why their gross margins are consistently high, right? And I think, despite all the example I've shared, right, you cannot take just gross margins into perspective. Context really matters, and also down the line your operating expenses, right? So it's very important to compare apples to apples. For example, you should compare AMD versus Intel instead of AMD versus DocuSign, or AMD versus Chevron, for example, because of the differences in the product and services that they are in, they provide, and the industries they are in. The cost structure and distribution and scalability structure is very different from each other. So it's very important to compare apple to apple. So in the case of AMD versus Intel, right, you could tell one has a lot better gross margins than the other. AMD has gross margins of close to 40%, while Intel has only a gross margins of only 27.5%. You can see that gross margin has been consistently increasing over the past 2 years, while Intel has been declining, right? And if you take a look at their share price, AMD has, consistently increased, while Intel is on the opposite path, right? So gross margin is a very quick way to tell whether a company in the same industry, selling the same kind of product services, which of them are likely to perform better, right? And also at the end of the day, cash flows and net profit still matters, right? So a company may have high gross margins, but it doesn't matter if they are perpetually bleeding cash without clear plans towards profitability. So the nature of their products and distribution channel could be very good, but if they have very high expenses in terms of their marketing, right, their manpower, headcount, etc. All this would still don't matter because it's not sustainable, right? Right, the company is just not well managed. Correct. So as an investor, right, you should use gross margins to screen out two companies that are competing directly or serving the same needs to quickly gauge which has more potential to deep dive further into. So after you tell, for example, in the case of AMD and Nvidia, you can tell which company has a better gross margins, right, for you to deep dive into. But you need to also take into account other things that are happening in the company, right? So you should always compare the other financials, right, like your expenses, etc., your net income, your share count, all of this. You take account valuation, right? Also very important. And also, deep dive into the company's what's happening with the company in terms of their earnings. Do they beat? Do they not beat? Right? Whatever they're saying, the earnings call, what's happening in the industry, right? So for example, now today AMD, they're forming a lot of partnerships with OpenAI, etc., which is why they're seeing a lot of growth, right? While at the same time, Intel is still trying to turn around the business, but they have a partnership with the US government going on. So a lot of things you have to take into context as well before you make your ultimate decision on whether you should invest into or not. You should just use the gross margin as a gauge to allocate your time to tell whether a company is worth looking further into, right? Because time is finite as well. So that's all for today. You can use StockPenguins.com's free tool to compare between two companies quickly, right? So visually, like that, right? You don't have to open two tabs, right? You can just have it here, and then you use the company's financial tool to deep dive further in the company if you identify one that is worth your time looking further into. So that's all for today. Thank you.